Okay, so about 10 days ago, we had the Bank of Canada drop our central lending rate to 3.75%. We've come down a full 100 basis points at this point. But interestingly, we've seen some of the 5-year fixed mortgages at the banks go up slightly over the last few weeks. So that's a bit of a disconnect for some people, and I wanted to just take a moment to kind of explain the difference between the variable rate and the fixed rate. The variable rate very much follows the Bank of Canada rate. So when they drop the overnight lending rate to the 3.75 by 50 basis points, you typically see the variable rate immediately come down in lockstep. A lot of them are tied to that prime rate, they call it. So if you have a variable rate mortgage, it's probably at prime minus something. So 3.75, then it might be prime, or it might be prime minus a little bit, or prime plus a little bit. You certainly have different banks offering different variable rates. But the fixed rate moves very differently. So a fixed rate is like you have your rate for the next 5 years, 3 years, 1 year, whatever it is. Very commonly that's 5 years. And those rates tend to trade off of the bond market. And the bond market is really controlled by traders, just like you would imagine stocks being controlled. There are people who trade these values, and they're really looking at this 5-year bond yield. So the 5-year bond yield is kind of just a fancy term for where do we think bonds will be in 5 years? Where do you think the right interest rate is 5 years down the road from now? Because that's what the bank is committing to over that 5-year period. They're saying, we're only going to charge you this amount. We know it'll be this for every one of your payments for the next 5 years. So these traders are trying to make sure that on behalf of these financial institutions that they understand, this is the right amount to charge someone so that you're charging a fair interest rate between now and 2030. So as you lock in those rates, they're not necessarily tied to what the overnight or prime rate is today. And that's why you'll see some movement between the prime rate and not necessarily see that fixed rate change a lot. So if you have a fixed rate mortgage and you're in the market to try and refinance or buy a new home, it's important that you talk to someone about what your length of term might be, whether you should take a variable for a short time, whether they think that the rates are coming down. Certainly as you see downward pressure on the prime rate, you will eventually see some downward pressure on the fixed rate. But again, they're trying to project out 5 years. So if they see that it comes down in the short term and then see it rising again, they're likely not going to change the pricing on that 5-year rate. So certainly some differences between variable and fixed, and I wanted to just take a moment to explain that.